Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome to America's Commercial Real Estate Show. Thank you for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Thank you for joining us. Remember, if you have any questions or comments related to this show or about any commercial real estate related issues, we do appreciate hearing from you. Our phone number is 888-612-SHOW. Our email is info@creshow.com. You can also connect with us through Twitter, LinkedIn, or smoke signals. Yes, that's right. Just go to the highest place in your city and look this way, right? Well, you can find them all at the show website, commercialrealestateshow.com. Well, today we're going to discuss CMBS loan resolutions. Look, if you have an interest in commercial real estate, then the distressed real estate is something you deal with or you want to know about. Well, today we'll look at CMBS loan resolutions, including restructuring, extensions, payment modifications, discounted payoffs, short sales, and debt relief. Really been looking forward to this show. And I want you to please welcome my guest, Ann Hambley, CEO with First Service Solutions. Founded in 2005, First Service Solutions was the first firm dedicated to serving as a borrower advocate for commercial-backed securities. As a veteran and CEO of leading commercial mortgage servicers, Ann Hambley recognized the need for a CMBS borrower advocate well before the collapse of the commercial real estate market. She's committed her career to utilize her thorough understanding of the servicing process to work for borrowers. First Service Solutions has completed more than $11 billion in CMBS restructures and CMBS assumptions on behalf of their clients. Ann Hambley, thanks for joining us today.
Thank you, Michael. I love your show, and I appreciate the opportunity to be here.
Well, thank you. And I'd like to kind of put the subject in perspective a little bit. You know, what are some of the current numbers for CMBS loans that are currently in default?
Well, there's about $60 billion right now in default, and there's about $80 billion in special servicing. And there's, just to give you the landscape, there's $700 billion approximately of outstanding commercial real estate loans right now, so for CMBS. So it's a little bit it's about a 10% default rate.
Okay.
Yeah.
So there's plenty of work out there.
Plenty of work out there.
Okay. Well, what about some of the loans coming due? And what are the numbers for loan maturities this year and next year? Are there a lot of loans coming due that we're going to have to deal with?
Well, let me just put it in a bigger, bigger perspective. So there's $2.9 trillion of commercial real estate all out there in the marketplace. Mm-hmm. There's $1.7 trillion of that is maturing between now and 2017. And if you think about it this way too, of the $700 billion of CMBS loans, about 85% of them, the majority of them, were originated between 2005 and 2007. Yeah. So they're all going to mature between now and 2017. So it's really staggering. Yeah.
And when you look at those maturities, how many of those do you think are underwater, where the properties are worth less than the loan amount? And then I guess there's another portion of those that maybe are worth more than the loan amount, but they don't have the loan to value ratio or the debt coverage. They're going to have trouble refinancing. Where do you think the struggles are there, the numbers there?
Yeah, well, I personally, I think a large percentage of all the loans originated in 2005 to 7 that were CMBS are underwater. So I think I'd say it's more than half are going to have trouble, if not even a higher number, are going to have trouble refinancing just because they're over leveraged today.
Okay. And we've had several shows on bank loans and workouts for bank loans, but CMBS is a different animal. And can you share a quick description of CMBS loans and how the pooling of loans affects CMBS loan for a borrower, and how the classes of bondholders work and affects a borrower with a CMBS loan?
Yeah. I know you said the show was exciting, but that's kind of a boring topic, but I'll try to make it a little interesting.
Our listeners are intelligent commercial real estate people. They love it. So.
Okay, good. All right. Well, let's go for it. So, if you're a borrower and you go to a bank and you get a loan, then you've got a lender, you've got a banker you can go talk to, right? But if the bank actually takes the loan, pools it together with other lenders' loans, and then securitizes it in the secondary market, that's a CMBS loan. They sell it off to a bunch of bond holders. And the bonds are rated by the rating agencies at the time the pool's created. So a certain percentage of the pool is assigned a AAA bond all the way down to unrated. So AAA, AA, etc. So the problem for a borrower is there's all of a sudden a whole group of bondholders they've never heard of, they don't honestly know about or care about probably, and vice versa. And so there's all these people now who will weigh into every decision they make on their real estate, and they don't even know who those people are.
Yeah.
So that's really how CMBS works and how it's different for borrowers.
And let's talk about those people making those decisions on a CMBS loan. When you're a borrower and you have a problem, talk to us about controlling class representative. If in those separate bond classes, if the value of the loan is less than the loan balance, which bond class is making the decisions here?
Yeah. Well, and it's funny because sometimes borrowers call me and they say, well, I'm debating whether or not I need an advocate to help me because I personally know my banker at Wells Fargo who gave me my loan, and so I think I'm okay. And I think, well, do you know who your special servicer is? Well, no, never heard of them. And then even if you know them, do you know who the controlling class representative is? Because there's all kinds of people behind the scenes. So the way to look at it is that the highest rated bonds are the lowest interest earning bonds. They're AAA. They're like pension funds and things like that. So they have a low risk tolerance. The lower rated the bond, so the unrated junk bonds obviously have a higher, healthier interest rate, but they have a high risk of having losses. And because of that, when people buy those low rated bonds, they say, well, if I'm going to have all the losses, I get to call the shots. So if there's a problem loan, I get to make the decisions. So the controlling class representative makes all the decisions on a loan that's in default, all of them. And most people would never know who those people are. Now, they get to pick the special servicer. So often they are the special servicer, but sometimes not.
Okay. So maybe someone with no interest anymore in that junk bond, let's say, doesn't have any more equity in this loan, as the property's worth so little, they're making decisions when they're kind of wiped out, right?
Well, that's right. Now, the current bonds, CMBS deals that are out there, the controlling class stays in position and stays the person who calls the shots as long as there's a dollar amount still left on their bonds. So it takes real losses passing through the pool before they're wiped out and the control changes to the next class of bondholder. Okay. So it's important point to note is that every single day the lowest rated bondholder is the one in control. So that can change tomorrow, it can change the next day, but it's real losses that cause it to change. Going forward in the new CMBS 2.0 and 3.0 that we've heard a lot about, the control can change based on anticipated losses going forward. So if you know economically that this property's underwater and it's just a matter of time, then the control can change. Today it doesn't, though.
So that can affect the decisions that the lender may have on those loans, depending on who's controlling it at the time, right?
That's exactly right.
Okay. And let's talk about some of the larger special servicers. I mean, you have LNR, C3, CW Capital, to name a few. And what are some of the differences one might find with dealing with the various servicers? Are there any more that are more reasonable or easier to deal with?
Mm-hmm. I'll get shot for answering this.
It's all right. We'll protect you.
Okay, thank you. So these earphones, are they body armor that will protect me? Okay.
They are. They have bulletproof glass here.
Oh, good. Okay. Well, then I can be honest here. Yes, there's a big difference between the special servicers, and even within the special servicers themselves, there's a big difference in the person that you might get, you appointed to, the asset manager. Now, at the end of the day, there are checks and balances. There's a credit committee that makes decisions. But let me just give you an example. Let's say that I'm your asset manager and I've been assigned your loan. And let's just assign me a personality of a difficult person. Okay. And I'm going into the credit committee to make it to get your deal approved. And I go in and go, yeah, this Michael Bull, oh my gosh, well, here's what he's asking for. And, you can imagine that sets the stage. If I'm going in and I'm saying, look, let me explain to you how amazing this opportunity is, what he's done, what he's bringing to the table, there's just a different tone. So right. The person matters, let alone the special servicer.
Wow. Yeah, I guess that. And I like it when they talk really good about me when you're... Well, what about some of these loans that are being resolved? I mean, there's various ways to resolve these loans, and I guess some of them are being extended still, but maybe not as much as they were being extended. And how many are kind of discounted payoffs? How many are foreclosed on, relatively speaking? How are these getting resolved?
The majority of them are getting modified. And the reason I think we're gonna get into that in a little bit. There's a lot of reasons why, but a very small amount is coming out in the form of foreclosure and REO. The latest statistics were 10% or something are foreclosed on and sold as REO. So they're getting modified.
Yeah, because they realize that's a hard way to go. I mean, they're going to have a lot of losses when they do that, right?
Absolutely. That is the absolute most amount of losses they can incur. Typically, time equals losses. So they're going to foreclose and sell it through an REO. It's a long period of time, and it will equal bigger losses.
Okay, and we're going to talk about that timing and how that handles the decision process in a CMBS loan workout or modification. We're also going to cover discounted payoffs and short sales and other issues you might have with a CMBS, with a client, or with your own loan. So we'll get right back and have more CMBS loan resolution information for you. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related subjects, check out our show podcasts. We recently produced separate shows on the REIT market, on senior housing, a great show on tax credits, and an interesting show on commercial real estate technology. There are lots of interesting shows to choose from. Just click the tab Shows on Demand at commercialrealestateshow.com. For today, we're exploring CMBS loan resolutions. My guest is Ann Hambly, CEO with First Service Solutions. And Ann, let's talk about you first have a problem with a CMBS loan. You have a problem, or you're going to have a problem. You talk to the lender, and you find out they don't really want to talk to you. Your loan's not being classified as a default. They don't really want to talk to you. You're not getting their attention because the loan is not with the special servicers. And some borrowers have resorted to not paying their payments to their lenders to get their attention. That's not a good move with a CMBS loan, is it?
Well, I always tell people, I tell borrowers this every day when I talk to them, but I said, let's just say, for instance, that your special servicer is the county jail, right? Because might feel that way sometimes anyway. But right. So I want to get to my county jail. Well, I have two choices, maybe more than two, but two I can think of. One is I can drive up to the front of the county jail. I can walk in the front door and I can ask to see the jail. Or the other is I can go 100 miles an hour in a school zone, and I'll probably get to see the county jail too.
Get there pretty
I'll
fast.
get there both ways,
Right.
But I'd prefer to pull up to the front door and go in the front door on my own volition. So an imminent default is a much better way to get their attention than missing a payment. That is definitely not the right way to do it.
And let's talk about imminent default. So you have to let the lender know that you're going to have a problem. It's coming. It's headed down the pike. And so how do you do that?
What you do is it's just that simple. You really notify the master servicer that it is a matter of time before you default, but that you're giving them an early warning. So there's a real live situation, a real live problem, and you're not going to continue to fund out of pocket and keep the loan current, and so you absolutely have no choice but to default in the near future. These are all for the most part, CMBS loans are non-recourse, so you can basically, you don't have to keep coming out of pocket to keep the loan current, and so. Yeah.
So you have to share with them why you're having that hardship, right? Why you're not able to make these payments, so they understand.
Yes, it's kind of akin to calling. I tell borrowers it's kind of akin to calling 911. So you're just alerting them that there's really a fire, there's really a problem, and I need help.
So they have to determine if it's a worthy default, imminent default, if they really think it's going to happen?
Well, it's kind of interesting because what they ultimately will want to do, the master servicer, if they can get you to continue paying out of your pocket on this size loan from now till maturity, they'd much prefer that.
Absolutely.
So, yeah. So there's times they may, play chicken with you a little bit to see if you're really serious. But through convincing, you can generally make them aware of the problem and get them to transfer your loan via an imminent default.
Okay. And Ann, you mentioned that CMBS loans are typically not recourse, but these loans do have carve-out guarantees, or bad boy carve-outs, as some people call them. What are the things that a borrower should do and maybe shouldn't do to avoid these carve-outs that could cause personal guarantees to come into effect?
Yeah, boy, that's a great question. There's some current issues in the marketplace that you'll hear about, but for the most part, here's the way it works. So they're non-recourse loans, which means that the lender's option in a default is to take the property back. That's instead of a recourse loan where they can take the property and or come after you personally. So
Right.
they take the property back. Now, there has to be these carve-outs that says, yeah, but if you lie, if you steal money from the property, if you burn it to the ground, if you do something to cause the value of my collateral to go away, then I come after you. So they really are bad boy events. Some people have concern that they're just, if I accidentally do one thing a little wrong, they're going to come after me. That's not what they're there for. So it's a bad boy event on purpose, and that's why they're called that.
Okay. So if I just quit paying my net cash flows, that may or may not be a bad boy carve out? Or?
It usually is not a bad boy carve out. Now, if you're taking the money and you're distributing it and buying yourself a yacht, then it might be, yes. But I mean, as long as you're doing things above board and you're for the most part, keeping the property in good order and sending in cash flow, then you're probably not tripping a carve out. Yeah.
I better move my yacht. Remind me to move that somewhere else.
Was it a CMBS loan though? Maybe not. No.
Well, let's talk about the time frames that a borrower should expect if he's having a challenge with a CMBS loan and he needs to modify it in some way. What kind of time frame should he expect to deal with?
A long time. It's actually on average about 6 to 12 months, hardly ever less than 6, almost always about 6 to 12, and it takes patience.
Okay, so real estate people aren't usually patient, right? So developers, and they want everything now, right? So you've got to be patient in this process.
Yeah, I'm not normally patient, but I've learned that you have to be patient. There is a process involved.
Yeah.
I had someone tell me once, it's kind of a funny story, that you can't line 9 women up, get them pregnant, and have them have a baby in 1 month. It takes 9 months. You can't put 9 people and have it in a month. And that's kind of how CMBS restructure
It's like
is.
having a baby. It's that tough, huh?
Yeah, I think it's probably just that tough, yes.
Okay. Well, what should a borrower expect for cash? Are they able to do some sort of workout on a CMBS loan, or are they going to need some money?
You have to have money. Absolutely have to have money. If the special servicer, here's the way they're looking at it. If you as a borrower are coming to this problem and you're bringing money to help with the solution, then they're likely to work with you. If you're not going to bring any money to the solution, then they might as well do it themselves. So that's really what it boils down to.
Right.
That simple.
Right. If you're not providing cash, they'll just take it.
Yeah.
Because you're not helping.
Yeah, and a lot of borrowers say, well, what about the millions I've been putting into it over the last few years? And I always tell them it's sort of that expression of, what are you going to do for me today? I mean, it doesn't
Right.
matter what you did yesterday, unfortunately.
Yeah. Well, a lot of business decisions need to be made looking through the windshield, and it doesn't matter what was in the past. Well, let's talk about pre-negotiation agreement. I mean, if you're a borrower and you're going to start to talk to your CMBS lender about working out and doing something with your loan to help you get through this problem time, they're going to require you to sign a pre-negotiation agreement. What is the borrower agreeing to there, and do they have to do it?
Yes, they have to sign a pre-negotiation agreement, and often that's where I've had some deals derail right there. If you have a tenant in common structure and there's 25 investors and you have one that will hold out and not sign it, it will stop the restructure. They won't talk to you without it. A pre-negotiation agreement, I'm very visual, so I always like to put something in what I can picture. A pre-negotiation agreement is like an Etch-a-Sketch. So the pre-negotiation agreement is taking the Etch-a-Sketch, flipping it over, and shaking it so that, boy, do they still have Etch-a-Sketches anymore? I thought that's probably with iPads. Maybe you don't need them. But anyway, if they still have such a thing, that's what it's like. You're wiping the slate clean.
And I guess you're agreeing not to file bankruptcy again, I guess? Or are you agreeing what else are you kind of agreeing to in there that your attorney might not like?
Well, the thing your attorney might not like is you're agreeing that you're not going to pursue the lender under any lender liability. So you're kind of waiving your right to go after them legally. You're basically saying that everything that we talked about in the past, or that the master servicer told me, we're going to start all over. It doesn't count. You're also the pre-negotiation agreement often makes you say that you are in default. And that often is a stumbling block also, because if you got there via an imminent default and you're not really in default, attorneys have a hard time allowing you to sign a statement saying you're in default. So there are some stumbling points to it, yes.
Okay, and we're short on the break here, but will some of these special servicers negotiate those agreements slightly?
Slightly, and that's such a key word, because when you get into long debates about the pre-negotiation agreement, it's a pre-negotiation agreement.
Right.
You have to wonder how the negotiation will go.
Okay. Well, if you have any questions about loan resolutions or a comment, tweet me. It's at Bull Realty. We have a lot more in store for you. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Ball, and this is America's Commercial Real Estate Show. If you're in any business related to commercial real estate, help our listeners connect with you. Post your services and contact information on the show's free professional directory. You can find the directory at the tab Professional Directory at the show website, commercialrealestateshow.com. Today we're exploring CMBS loan resolutions. My guest is Ann Hambley. She's CEO with First Service Solutions. And Ann, I'd like to talk about the decision process for these CMBS lenders. So if you're a borrower, you have a CMBS loan issue, you need to analyze what the lender may be willing to do, right? So what might a lender consider, when they might consider extending the maturity or adjusting the payment versus a debt deferral or a partial debt forgiveness on a deal? How do they make those decisions?
Well, that is absolutely the key question I think I get asked every single day, and that's probably one of the main benefits in having an advocate, because when you sit down with you don't sit down with them, but when they first speak to you, the first thing they ask you is, what do you want to order? What is it you want? And I always say it's kind of like sitting down at a restaurant, and they've got the white tablecloth, and the waiter comes over and says, what do you want to order? And you say, well, I don't have a menu. I don't actually know what you serve yet. And they say, well, can't tell you. So, okay, well then I'll take chicken. Okay, well, we don't have that. Okay, well, then I'll take a steak. We don't have that either. So that's kind of what the process feels like. So that is the number one question every borrower says is, what are my options? What can I do? So think of it this way. The decision tree is a little bit like this, if I were going to oversimplify it. There's a million varieties under chicken on a menu, but let's just oversimplify it for a minute. So you've got a loan that's currently not performing. That's the premise, of course. So the first question is it underwater? Is the value less than the debt? If the answer to that is no, it's not underwater, it's just a temporary cash flow issue, then you're probably looking at a payment modification. That makes sense. That's the easiest, of course, of all. If you've got a loan that's maturing and you just can't pay it off, you're looking at an extension. Now, in between all that is where a lot of the stuff lies. And so then the question you have to ask first is the property underwater? If the answer is yes, it is underwater, then the next question is, okay, will it likely recover its value by maturity? The answer to that is yes. Then you're looking at debt deferral, because you don't want to write it off. It's going to come back. It just needs time. Right. However, the answer to that question is property's underwater, but it's not going to recover its value. It's just been over leveraged for a long time. Then you got to do debt forgiveness. And there's lots of ways to do debt forgiveness. Discounted payoffs, note sales. We can talk about all that, I think, in a minute. But that's the basic way that you know what your options are. Okay, well, that makes sense. And let's talk about net present value. I mean, the lender is looking at the value of the property, and then they've got to make a decision if they did take it back, what's the result going to be there. So can you share how servicers make decisions around net present value? Yes, I definitely can do that, and it's a little complicated for this setting. But let me describe it very generally. Because remember again, the controlling class certificate holder representatives calling the shots. They're the ones to have the first loss. I remember back in the beginning of this industry when we created CMBS, we thought, that might be a conflict. They might be motivated to make a decision that might not benefit the other bondholders, because they all have different motives, right? So we created a rule, a kind of a golden rule or a servicing standard that they must comply with when making their decisions, and it's a safety guard, if you will. And what it says is they've got to make a decision based on whatever will yield the bondholders, all of them, the greatest recovery. Makes sense. It's that easy. Now, the way they calculate that is they take their own foreclosure and sale scenario. So if they foreclose and they sell, it's going to yield them a certain amount of money. They have to net present value that to today.
Now let's talk about that for a second. So they look at their valuation of the property, maybe brokers' opinions of value, maybe appraisals, but then they have to figure out, all right, well, that's the value of the property, but what other costs are we going to have if we foreclose? Tell us about that.
Yeah, well, the difference is, so like a bank loan, the cost to foreclose might just be the cost to foreclose. On CMBS, the cost to foreclose includes the cost of keeping the bondholders current during the whole time you're doing it.
That's very key.
Very key.
Yeah.
So the time involved in foreclosing will absolutely impact the net present value tremendously.
Okay, so they're looking at the foreclosure costs, they're looking at the management costs, they're looking at the cost to get there. Then they're also looking at how long it's going to take to get through that process, because when they're going through that process, the special servicer's having to pay the bondholders.
That's right.
Okay. All right. Well, great. We're going to get more intel for you on CMBS loan workouts. Stay tuned. You're going to get some great information. I'm Michael Bull. You're listening to America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. We've been working on some incredible shows for you coming up soon, including separate shows coming up on office, retail, industrial, and the multifamily markets. Don't miss a show of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Well, today we're exploring CMBS loan resolution issues. My guest is Ann Hambley, CEO with First Service Solutions. And Ann, we've talked about the time frame that a CMBS lender is going to take into account when they're making these decisions based on the foreclosure process in each state. Tell us a little bit about that and how that differs state to state.
Yeah, well, the best way to describe the difference is, let me give you two states. So New York, it takes, like 445 days in a perfect world. Wow. So it's backed up a little bit. So call it 2 years in the court system to foreclose, okay? So those same 2 years, the special servicers keeping the bondholders current, right? Now, let's go to my state of Texas, and they can shoot you on the first Tuesday of every month. So there's no playing around in Texas. So there's a huge difference,
you don't
obviously.
Mess with Texas,
you don't mess with Texas. That's exactly right. I have one of those posters, I think, too, yeah.
Yeah, so they got to look at that cost of that time frame, and not only those cost of holding or what might happen to the property and those sort of issues, but paying those bondholders.
That's right. So like so you have two properties, exact same owner, and you put one in New York, one in Texas, you're going to have a very different outcome.
Right. Okay. Well, let's look at the plans. If you're trying to work out a plan, the servicer has a defaulted loan. They want to know that if you're going to control the asset and extend the term or restructure the loan, they want to see a realistic plan from a borrower. Tell us what should be included in that plan for best results.
Yeah, thank you. They should, number one, it's got to be a couple key things. One is, what's the value today? Now, a lot of borrowers say, well, I don't know. Okay, but we have to take an educated guess. We have to start somewhere. Where's the value today? Where's it going over the next few years? How's it going to get there? And what's the cost of getting there? Where's that cost coming from? And then most importantly, what's your exit strategy? How are we all getting out of this? It's pretty much that simple.
Okay.
So it's all value driven. Value today, value in the future. How do we get there? What's the cost of getting there? And again, exit strategy.
And what's going to maximize the value to the bondholders? That's
right. And all of this is reviewed under that scenario.
Okay. Let's talk about discounted payoffs and short sales. If a borrower is looking to refinance a property with a new lender at a discounted payoff with the existing lender, or they want to structure a joint venture with a partner, or maybe they just want to sell the property on a short sale and get out of it that way, what is the best way to go about that with a CMBS loan?
Yeah, the way to answer it, I think, really is that the special servicer does not care where the money comes from to pay them off. So let me back up a little bit and say, so we've concluded, I think, when you talk about short sale, discounted payoff, etc., we've concluded that a debt deferral is not the right solution. So we've concluded that it's just upside down.
The value's not going to be there before it matures.
Yep.
It's just upside down, so we got to do something more drastic.
Just
right?
Call it a day and figure out how to get out of it, right? So we figure out an amount with a special servicer. So what's the amount they'll settle on? And then the bottom line is the money could come from the borrower, and in that case it's a discounted payoff. The money could come from the borrower, but the borrower buys the note. It's a note sale. They would do it for tax reasons. The money could come from a third party, and that would be called a short sale. The borrower could go rob a bank. It doesn't matter where the money comes from. They just want to be paid off at a certain amount of money.
Okay, and we're not recommending.
We're not recommending,
especially in Texas, right?
Yeah, where they'll shoot you the next Tuesday, right? No.
And let's talk about it. I think one thing that's interesting about CMBS versus bank loans is the fact that, from what you're saying, you go to the lender, you show them the value, you show them the plan, you show them the cash flow, you show them the leases, and you work out what that discounted payoff is up front before you go try to sell the asset, right?
That's correct. Okay. Absolutely.
Okay. So that means that if they don't care where the money comes from, you could get a lower payoff than maybe you sell the property for, especially in those states where you have a long foreclosure process, right?
That's correct. Absolutely.
So there still could be some cheese for the developer in that deal, right?
Right.
The sponsor could still maybe get some. I know when a lot of times in the bank loans, and they say, "Hey, we're in trouble. Come help us." And are you looking for some cheese still, or you're trying to get out of the trap? And with a bank loan, the banks don't like to see the developer get any cash. But in CMBS, they're just trying to maximize the value for the bondholders, right? So once you negotiate that payoff, if the original sponsor gets some money, they're okay with that.
They're just looking to see who moved their cheese. That's right. And we did a deal not that long ago where they had this exact example. Do you want me to walk you through that?
Yeah, give me an example of that. I think that's very interesting for listeners to hear that.
Yeah, and it's important to know that this property was in New York, and I think that's one of the key reasons. It was an empty building in New York. Mm-hmm. So not only did you have to keep borrowers, the bondholders current the whole time, but you had carry costs of the building, empty building. You had no income coming in. So you now factor in that it's going to take 2 years to foreclose, another year to sell, and all of a sudden your net present value is a significantly lower number than the current value of the property. Okay,
right.
So the borrower sold it for the current value, let's say, and the special servicer accepted something greater than their net present value. But there was enough money there, absolutely, to allow the borrower and sponsor to put money in their pocket. And everybody says, well, how would they let you do that? Well, again, it's based on what will get the bondholders, all the bondholders, the most amount of money. And this was a win-win-win for everybody.
Right.
Yep.
So if the net present value was decided was, say, $20 million, but the appraisal of the property was $30 million, and that developer gets that negotiated to $20 million, but he's able to sell it at $25 million, well, they got $25 million for it, so they were $5 million better than if they'd have foreclosed. They're hey, that's great, right?
Exactly.
We did our job.
That's exactly right.
Right.
Exactly.
All right, but the original sponsor may still get the difference between the selling cost and the $5 million.
They would.
Right.
They would, absolutely.
That's interesting. Well,
Yep.
You heard it here on the Commercial Real Estate Show. Now you know. All right, we're going to have to take a short break, but we have more intel headed your way on CMBS loan resolutions. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. and by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. Do you utilize social media like Twitter or LinkedIn? Well, the typical challenge with social media is finding good content, right? Well, you're invited to use this show as informative content for your social media endeavors. There's a share bar on each show page. Just click it and share great knowledge with your connections. Speaking of knowledge, today we're exploring the Cmbs loan resolution issues. My guest is Ann Hambley, CEO with First Service Solutions. And when should a borrower get an attorney involved in this process?
Well, they'll need an attorney involved the whole way through, but you want the attorney not to be the frontline negotiator with the special servicer, because if you do have them as the frontline negotiator, then the special servicer will get their attorney involved. So then you'll have attorney-to-attorney combat. So attorney needs to be there, but they're going to be primarily there to review any legal notices that you receive, and mostly to document the end result or the modification that you get.
Okay, that makes sense. You don't want it to start out adversarial.
That's correct, yeah.
Okay. And what if a CMBS lender has put a receiver in place to control the asset? Is the borrower out of the picture at that point, or might they still have the opportunity to resolve a loan with some benefit to the borrower?
They're not out of the picture at all, and there is absolutely still some benefit. Take that New York property I told you about that was empty. Carry costs were $3 million a year. So the borrower either had to come out of pocket for that money, wasn't willing to, or a receiver was appointed. So it was a benefit to both parties to get the receiver involved. So sometimes it's a benefit.
So there was a receiver involved in that one?
There was.
Okay. Well, what are some other tips or advice you would give our listeners that are in a CMBS loan issue?
Well, I always say it's almost like, I know if you're a borrower and especially if you haven't been through this process before, a lot of these borrowers are, borrowers who have made all their payments in the past and have been good borrowers and are very concerned with what to do, yet they don't want to make the unintelligent decision of coming out of pocket to keep a loan current that's non-recourse. So they're staring at this daunting challenge. I say it's like you're standing at the base of Mount Everest. You're looking to climb it, and it would be like me standing at the base of there today. I'm not equipped to climb it. I don't know how to get to the top. I don't even know the first thing. So you want to hire a Sherpa. You want to hire someone who's been there before, who knows what kind of equipment you need to get there, who can tell you when to stop and take a break, and most likely how to get there without dying, right? And how to get in shape before you start it. So I think the number one thing I'd like to say, the tip is hire an experienced Sherpa to help you along the way. And this is not a commercial, obviously, for my firm, but that's what my firm does, and I think it's important that a borrower has a knowledgeable advocate.
And what is the time frame? When should they have an advocate involved and talk to someone like you?
The sooner the better. So ideally, it's right at the point where you have an imminent default coming around the corner. You don't want to be already in the county jail and call and ask what the speed limit was out there on the sign. It's a little late then. Not that it's too late, but the sooner you involve an advocate, the better.
Okay. And if some of our listeners would like to access more information about these type of issues, what are some resources out there for them?
Well, besides your show, obviously, which has a lot of great information. Our website has a lot of. I do webinars. I don't do TV usually or radio, although I love this medium, but. We have a lot of webinars, and on our website, firstsss.com. I know you probably linked it on your...
Yeah, and that's 1stsss.com?
That's correct.
Okay.
Yeah. So there's a lot of information there.
Okay, and there they can access some of the webinars and things, right?
That's correct. Yeah, you can replay them. If you have trouble sleeping at night, they're always a great, remedy for that. But but they are a knowledgeable, informative CMBS shows.
Okay. Well, Ann, thanks for spending some time with us today. We sure appreciate you sharing some insight with our listeners around the country.
My pleasure. Thank you.
Thank you. And if you'd like more information from Ann, like she said, her website is 1stsss.com, or we'll have the link for you always at commercialrealestateshow.com. Can you join us next week? Well, I hope so. We'll have another informative show, this time on the U.S. office market. Thanks for spending some time with us. I'm Michael Bull, and until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.